Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
All right, let's dive right in. We're focusing today on Taiwan's semiconductor manufacturing company, which is, really the singular industrial force setting the pace for this entire age of intelligence. The stock, TSM, closed yesterday at $314.51 on pretty significant volume. That pushes its market cap to just a staggering $1.66 trillion. Now, this rise translates to a forward price-to-earnings multiple of roughly 27 times. So the real question facing every serious investor is this. Is this elevated valuation a fundamental recognition of TSM's operational superiority, a justifiable premium, or is it, a fragile structure built on distorted market mechanics? I'm firmly on the side that TSM's monopoly of capability and its sheer execution fundamentally support this premium.
Yeah, and I see that, but I think I come at it from a slightly different angle. Look, I fully acknowledge the stunning quality of TSMC's operation, the silicon hegemon, as you put it. But we have to isolate the corporate quality from the equity structure itself. I'm going to argue that these structural anomalies in the American equity market and frankly, a dangerously pervasive crowded trade sentiment have introduced an asymmetric downside risk that the TSM's excellent fundamentals just can't fully protect against. The valuation, in short, is structurally vulnerable.
Okay, but let's anchor this in industrial reality for a second. Let's talk about the competitive mode. TSM isn't just leading, it has achieved an absolute, unassailable technological separation from its rivals. The mass production of the 2-nanometer node, N2, it commenced in Q4 of 2025, right on schedule. That success alone guarantees TSM the exclusive manufacturing pipeline for every single major AI hyperscaler for the foreseeable future. Now, you contrast that with the competition. Intel is just locked in these turbulent struggles to stabilize their 18A node. They're repeatedly delaying timelines, and maybe more critically, Samsung keeps grappling with these persistent yield challenges, which are largely tied to their use of the gate-all-around or GAA architecture. TSM tactically avoided GAA for its N2 rollout. It prioritized maturity and yield. And this conservatism, paradoxically, has given them the flexibility and scale to keep gross margins near 60%, margins usually see with software companies, not capital-intensive foundries. So for a company that effectively controls the production of global compute, a 27 times PE it's just a recognition of its status as a secular growth compounder.
I respect the execution, I really do. But fundamentally, the operational perfection of TSM is almost irrelevant now to the structural flaws I'm seeing in its stock price. We have to focus on the equity structure, which is showing some really dangerous fissures. The most glaring sign is the historic breakdown of the traditional ADR arbitrage trade. We are seeing a scarcity tax being pulled from U.S. investors. The American Depository Receipt, TSM, it is blown out to a 20 to 25% premium over the Taiwan common share. Now, paying a fifth more for the exact same underlying claim on corporate assets it's just profoundly irrational if the market were functioning efficiently. It suggests a deep segmentation. And furthermore, this valuation, it lacks any structural hedge. Short interest is negligible. We're talking 0.6 to 0.7% of the float, with days to cover at a mere 2.6.
This is the definition of a one-sided market. It signals the capitulation of the arbitrageurs, when basically every sophisticated player is long and retail commentary just confirms this widespread euphoria, the constant no-brainer buy consensus. We have a crowded trade. And that fragility means that any change in sentiment won't be met by short covering. It's going to be met by a liquidity cascade of forced sellers.
That structural diagnosis of the ADR spread is certainly compelling, but I would argue you're defining a symptom of overwhelming, sustained institutional demand as if it's a market failure. Yes, the premium is 20–25%, but why has the arbitrage failed? It's failed because of what you could call liquidity segmentation. You have these multi-trillion-dollar passive funds, the AI ETFs, the NASDAQ 100 trackers that are often mandated by their charters to only hold U.S.-listed securities, or, they face incredible structural friction in accessing the Taipei exchange.
Sure.
So this creates a segment of the market that's inherently price insensitive. They must buy the ADR regardless of the spread. That external structural force is what's masking the traditional price discovery. So the premium isn't a rationality. It's proof of TSM's indispensability. It's proof of the overwhelming structural institutional demand to own the only liquid vehicle available to them.
I'm not convinced that defining price insensitivity as a strength is a safe argument. I mean, if the majority of marginal buyers are these mandated passive funds, that just means price discovery is impaired. I respect the institutional reality, but paying 25% more for an identical asset is unsustainable, regardless of the...
But is it unsustainable, or is it just a new reality of market structure?
It's the market equivalent of buying bottled water in the desert for 5 times its price, even though the common share fountain is right there. The moment those passive funds face mass redemptions, or they have to rebalance out of these high-flying AI stocks, they will become price-insensitive sellers, and they will sell the most liquid vehicle they hold, which is the ADR. This rapid compression of the premium will lead to immediate, disproportionate losses for ADR holders. I mean, are you arguing that investors should intentionally expose themselves to this avoidable risk just because of institutional friction?
I argue the institutional reality validates its unique position. But all right, let's shift the focus to genuine company-specific risk mitigation. A persistent tail risk that historically depressed TSM's multiple was, well, the geopolitical threat. And Dr. C.C. Wei's leadership has actively de-risked this. Specifically, his technocratic diplomacy secured the January 2026 renewal of the U.S. VEU export license for their Nanjing, China operations. This renewal ensures TSM can continue to service specific, high-margin revenue streams to Chinese clients using less advanced nodes. It removed a significant, persistent threat to their revenue. And this strategic competence, it fundamentally compressed that geopolitical discount that used to weigh on the valuation, making the stock objectively safer in 2026 than it was in 2025.
See, I understand why you think that, but I would frame the removal of the geopolitical discount as more of a dangerous psychological capstone, not a complete risk elimination. Management competence in securing that license is commendable, but the market is now engaging in what I would call risk nihilism, the psychological removal of the risk entirely. I mean, the retail narrative seems to be, if China invades, everything collapses anyway, so why bother pricing in the probability? This widespread sentiment means the stock is now priced as if it were a domestic U.S. company. It is not. You've secured the short-term continuity of Nanjing's revenue, which is great, but you haven't eliminated the fundamental macro correlation risk. TSM still carries a high beta of 1.29 to the NASDAQ, so it will fall and fall disproportionately during a major market correction. Securing the Nanjing license only reinforces the dependency on China for a significant portion of their revenue.
That's a thoughtful challenge on the dependency, yeah. But the strategy is clearly multi-pronged. While they maintain those crucial legacy revenue streams through Nanjing, TSM is simultaneously using its capital to stand up new advanced fabs in Arizona and in Kumamoto, Japan. That's to directly address the geopolitical concerns of their key clients, like Apple and Nvidia. The diversification is happening, it just can't happen overnight. What the VU renewal did was buy them time and stabilize the cash flow needed to fund these massive global buildouts.
I agree the build-out is necessary, but the market is pricing in the success of the build-out and zero geopolitical friction, which is the heart of my concern. Let's talk about that beta of 1.29. Yes, it links TSM to high-growth tech, but it also links it directly to macroeconomic deleveraging risk. TSM isn't a software company. Even with 60% margins, it's a capital-intensive hardware manufacturer. If macro factors cause a correction, sticky inflation, a recession scare, TSM, because it's so liquid and widely held in all those passive funds we talked about, it becomes a prime target for deleveraging. Investors sell their liquid winners to raise cash.
But that liquidity is precisely what makes it attractive. TSM is seen as the safer way to play the AI theme. It's the definitive arms dealer to all sides. Its revenues are insulated because whether NVIDIA wins, or AMD wins, or Google's custom silicon triumphs, TSM is the manufacturer. This industrial centrality justifies the 27 times premium, especially when you compare it to a true cyclical play like Intel, which trades at, 18 times forward earnings? We're projecting EPS growth in the 20 to 25% range for 2026. Given that growth rate, 27 times is far from extreme. And Wall Street agrees, with a median price target of $352.
I mean, those projections are priced for absolute perfection. Let me tell you why the downside risk is so significant. The complete lack of short interest. In a healthy market correction, short covering provides a natural cushion, a source of inelastic buying pressure as prices fall. With short interest effectively dead at 0.6%, there is no cushion. So if that high beta of 1.29 kicks in, the stock is exposed only to downward liquidity flows. Can this price withstand a compression back to historical PE multiples, which hover closer to the high teens? If TSM reverted to just 18 times PE on projected earnings, that implies a bear case price around $240. That is substantial downside that the current euphoric sentiment is completely ignoring.
Look, the fact that arbitrageurs have capitulated and short sellers have fled, it suggests a rational fear of being squeezed by that mandated inelastic buying from passive funds. This is a new structural reality. And I must reiterate, the fundamental thesis is intact because the technological moat, proven by flawless N2 execution, and the strategic leadership that has managed geopolitical risk, provide a durable basis for this premium valuation.
And I maintain that the technological moat is a necessity, but it is not a guarantee of insulation from market forces. The current market structure is brittle. That 25% ADR premium is a flashing indicator of irrational segmentation, and the negligible short interest signals an overheated, crowded consensus. Fundamental strengths alone cannot protect investors from the systemic risk that accrues when market mechanics get this stretched.
So the crucial determination for 2026 then remains whether the market ultimately values TSM based on its flawless technological execution, its industrial superiority, which is superb, or on the sustainability of this current almost euphoric market liquidity that has blown out the ADR spread.
Agreed. It's the confluence of these two forces, industrial execution meeting structural equity fragility, that makes TSM not just a cornerstone of the tech sector, but, well, perhaps one of the most volatile and intellectually complex components of the trillion-dollar club this year.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.